for that. Well, we have a special set of guests now joining us. Balasubramanian is Managing Director and Chief Executive Officer at Birla Sun Life Asset Management Company. Mahesh Patil is Chief Investment Officer at Birla Sun Life AMC. Gentlemen, great to have both of you here. Thank you very much. Now, AB Sun Life AMC has put out their annual outlook, both for equities and debt as well, fixed income as well, for 2023. So, let's actually sort of talk about that with both Bala and Mahesh. Gentlemen, welcome again. Bala, if I can start with you, what's the big top-down kind of call in 2023 to your mind? From what I read in terms of your outlook, what you're saying is this is the year in transition. Valuations are not cheap and growth is slowing a little bit. So at the margin, a little cautious. Bala?
Thanks, Prashant, for having me for the show. I think the outlook that we have is the year 2023 is a year of consolidation as far as the equity market concerned. But having said that, the broad buoyancy that got built up in the last 3-4 years due to the government spending, public sector has been the biggest spender, the government has been the large spender in driving the economic growth. That we believe, I think we should continue. We may also see the interest rate hike that we have seen in the last 1.5 years. We should see actually peak of the interest rate cycle. But it's having said that, the liquidity tightness has also been being witnessed in the market. That reflects on the way money market yields have gone up, the way the bond yields have gone up, and that I think probably should continue for some time. But at the same time, the reversal of currency outlook should also help Reserve Bank of India to provide some more liquidity in the systems if the interest rates moves up quite significantly. At the same time, the banking industry have been witnessing high credit growth, which is nothing but a reflection of, in general, the consumption-driven growth is coming in, and therefore the broad outlook from our point of view is while the macro factors continues to be favorable for driving the economic growth to the next levels, but having seen a significant movement in the equity market, therefore we should see some consolidation, and at the same time, the bond market side, the way I think most yields are moving. There's also a reflection of some bit of growth coming back. That's something I think should keep the overall the economic growth on track. At the same time, so this year, of course, the budget is there. The budget also, our own belief is in the current year, given the high level of buoyancy that you have seen in the tax collections, both on GST and in the general direct tax collections, we will probably see Government of India may have enough room to continue their government spending this year too, followed by the private sector capex to pick up as we start moving ahead. And that's something is a broad outlook that we have as far as the 2023 concerns.
Okay, all right. Hi, sir. Good afternoon, gentlemen. Well, the question is that if equity markets are going to have some bit of headwinds going ahead, and it could be a bit of a year of consolidation before taking off yet again, what about asset allocation? Suddenly, gold is moving towards fresh highs. Bond yields as well are moving up. Fixed investments are giving you a fair bit of money. So between equities, gold, real estate, and other safe investments, what should the asset allocation strategy be for 2023?
I think clearly we feel that this year you will get definitely asset allocation will play a very key role. And given the fact that the fixed income rates are high and which have almost gone up about 2.5% in the last few years, as it is, the banks who have been actually keeping the deposit rates pretty low for quite a number of years, now they are beginning to see some bit of pressure getting built up, even the deposit rates to go up. So therefore, the fixed income product on mutual fund space definitely becoming one of the asset class to consider. It doesn't mean it comes at the cost of equity. Equity, of course, will go through an investment phase for a longer period of time. At the same time, dollar-based assets, given the fact that the US dollar could weaken compared to other currencies, having seen the last 1.5 years, dollar gained a significant strength compared to other currencies. We see some bit of reversal happening given the fact that mild recessions could hit the US market. That is being either one of the way I think play the dollar is actually through the gold and the silver. We believe in general commodity space will remain somewhat buoyant. That again makes it a little more attractive enough to look at asset allocation fund that invest not just on equity, fixed income product as well as on commodities. So naturally, given the differential between earnings yield versus the bond yields, makes it more appealing to invest in fixed income product, and a mix of this asset class, asset allocation fund becomes actually a way of investing for 2023. But having said that, I think equity is something, while it may go through a time value corrections or maybe a consolidation phase.
Yeah.
But equity is something that one should not ignore, given the fact that asset class actually is meant for longer term savings on the basis of various goals that one may have. S&P way of investing has remained one of the way of investing. That we believe, I think it should continue.
So I'm taking all of that on board, but what about if you had to give a percentage to it? Y'all would be investing as well. So how much would go to equity? How much would go to gold? How much would go to fixed investment? Just a rough number, it gives a broader sense.
I think the way we measure this actually is, I think we run one of the allocation fund, which is the balance advantage fund. As it stands today, taking into account various considerations, whether it is valuations, whether it is volatility or is the momentum, any parameter to look at this point of time, we have almost about 45% of our assets in equity. Rest is, of course, coming in fixed income. That gives an answer. 45 to 48% should be in equity, rest should be in other asset classes. And within the other asset classes, given the fact that gold and asset class, gold and silver as an asset class does not have the coupon bearing, at the same time it does give an appreciations. Therefore, we believe that about 15% should be allocation towards gold and silver, and rest should be in the fixed income asset class, which has got a larger proportion of the income coming out of the accrual. That gives a higher level of safety, at the same time high level of prediction on the portfolio return.
Okay, so let's talk about where pure equity investors should be investing in. Mahesh, afternoon. Looking at your key themes and sectors of interest, digital and new age technology. That entire bunch took the brunt of the PED rating last year as interest rates started to rise. What is your expectation when it comes to these new age tech companies? What's the thesis that you're working with for this year?
Yeah, so this year we are looking at four major themes. One is the banking and financials, consumption. Okay, within that discretionary consumption, though currently it is going through a kind of a slowdown, manufacturing, and then technology, because we believe that technology, while this year, okay, there is some concern about growth slowing down, but I think the move towards digital is going to be slightly longer term, and Indian IT companies are well positioned really to capture that. And some of the new age technology companies which have gone through a brunt on the back of global meltdown, we are seeing now that the valuations there are looking not very cheap, but okay, where we can actually value some of these companies based actually on their profit multiples, say 4 to 5 years down the line, and then apply a traditional multiples. So within that, companies which are already well established as leaders have already got a road to profitability and likely to become profitable this year, are companies which we would look at. And I think you will have winners over there also, because there are disruptors in each and every segment. Only thing is that one has to really tread carefully in this space, because the volatility is going to be much bigger over there. So the allocations there could be much smaller. So I think these are the broad four themes which we think will play out, not necessarily from a very short-term perspective, but from a medium-term perspective.
Mahesh, so the themes are banking, financial services, discretionary consumption, domestic manufacturing, right? And you'd keep some of the global cyclicals away. Within domestic manufacturing, what should one really focus on? What kind of sectors, subsectors?
So domestic manufacturing, again, would be driven by the whole China Plus One policy, the government focus on PLI, okay, which is driving investments over there, and generally the pickup what you will see in the broader economy. So within that, I think sectors like, for example, chemicals, okay, which are currently going through some period of consolidation. We have seen some weakness over there on the back of global slowdown. But I think structurally, long-term story there looks fairly strong. Specialty chemicals, the whole shift, okay, which is moving out of China, is a structural one. And we see that as a good theme to play out, especially within the manufacturing side. But the whole investments in the manufacturing will also mean that a lot of these industrials and capital good companies should also benefit out because of the investments which will happen over there. And within that could also be a good, interesting sector where we are seeing companies having improving order book, and also some of these companies are catering to the export market. And they're also, because of the disruptions, what we have seen, some of the companies are actually benefiting out of that. So I think industrials and capital goods could also be an indirect play over the manufacturing theme.
Banking, financial services, Mahesh, will the advantage still be with banks, or you think, within NBFCs? NBFCs, if you put a range of NBFCs on a valuation curve, the amount of dispersion is very large. There are NBFCs at 1-time book. There's Bajaj Finance still at 6.5 odd times book. What's your sense between banks and NBFCs?
So I think banks would continue to do well, I think, because in the period of higher interest rates, I think access to low-cost deposit, will be an advantage over there. And banks, especially with a strong liability franchise, would probably do well over the longer term. Currently we are seeing that the banks are benefiting because of the increase in interest rates, because their repricing of loans is happening much faster than the increase in the deposit rate and the CASA book what they have. I think a quarter down the line, you will see the NBFCs also starting to really get the benefit of increasing interest rates, or being able to pass on those rate increases. So I think that probably is likely to happen in the first quarter onwards. And within the NBFCs also, I think companies which are more on the retail side are companies which we think will do well. And one would want to stick really to the larger NBFCs, which are much more stronger, have a stronger balance sheet, and are able to raise loans at a much more competitive rate.
Mahesh, very quickly, why not insurance and why not real estate? Insurance has been beaten down. The valuations are far more palatable now. So why is insurance not one of your preferred themes right now? And what about real estate? Because everyone says real estate is in an upcycle which will last for a couple of years, and we're only at the beginning of it.
So when you talk about banking and financials as a broader theme, insurance also is a part of that. So we are positive on insurance. The sector hasn't done much in the last 1 year, where we've seen that because of the price increase, especially on the life insurance, there has been some kind of a slowdown and margin pressures. But I think post the underperformance, what we have seen last 1 year, and this is a sector again which should again see a much more steady secular growth for around 15% or so. Valuations are also now reasonable, and visibility of growth is much better. And in this kind of an environment where there are concerns about growth and high valuations, insurance also is a sector, especially life insurance sector, which looks attractive at this point in time. Real estate also has been doing fairly steady. We have seen a good pickup in terms of new home sales. I think the outlook there still remains fairly positive. Again, it's a very narrow theme, and that's why we have not really put it as a part of a larger theme. But again, while interest rates have gone out, mortgage rates are now high by around 200 basis points or so. Could see some kind of a slowdown, but I think the demand for real estate from genuine buyers still remains fairly strong. Pricing, real estate prices are stable. We have seen some increase in especially markets like Gurgaon. So, outlook remains fairly positive on real estate also.
Bala, Mahesh, thank you very much for joining us and speaking about the outlook for 2023. Need to get into a very short break. As we do that, here is something that you, our viewers, must take note of. CNBC-TV18 and the National Stock Exchange have come together to promote investor awareness through a special campaign, Informed Investor, that empowers you to make the right decision with your money. Nothing in life is guaranteed, but many investors fall for the guaranteed returns gimmick. A smart investor always avoids investing in such schemes and is aware they are illegal and must be reported to the exchange. Any investment in such schemes is not eligible for compensation from the exchange. Hence, it is wise to avoid investing with anyone promising guaranteed returns in the securities market.